Hi, I'm Vineet from ClearTax. In this video, we will understand all about mutual funds. A mutual fund is an investment vehicle formed when a pooling entity called the fund house or asset management company pools investments from various individuals and institutional investors to purchase securities. These investors have common investment objectives. Mutual funds are popular among millennials since they provide flexibility which other investment options don't. The mutual fund industry in India is well regulated by the Securities and Exchange Board of India, the Reserve Bank of India, and the Association of Mutual Funds in India. Therefore, your investments in mutual funds are absolutely safe. Mutual funds are broadly divided into equity funds, debt funds, and hybrid or balanced funds depending on the equity exposure. Equity funds are those funds whose equity exposure exceeds 65%. Debt funds are those funds whose exposure towards fixed income securities exceeds 65%. Balanced or hybrid funds invest across both equity and debt securities to balance the risk-reward ratio. All mutual fund units are bought and sold at the prevailing NAV or net asset value. It is also referred to as the cost of fund unit. A mutual fund invests across several assets. For example, an equity fund invests across several shares, a debt fund invests across several debt and fixed income securities, while a hybrid fund invests across shares and fixed income securities. Let's now understand the risk level of mutual funds. Equity funds, as the name suggests, invest mostly in equity shares. Therefore, these funds carry the highest level of risk among all mutual funds. Debt funds, as the name suggests, invest mostly in fixed income securities. Therefore, these funds are known to be carrying lower risk than equity funds. Let's now look at the reasons why you should invest in mutual funds. Expert money management. All mutual funds are handled by finance professionals called fund managers. These individuals are finance professionals with excellent track record of managing portfolios. The fund managers and the team of experts and analysts do the research and pick the best performing stocks and debt instruments that will benefit investors in the long run. No lock-in period. Unlike many traditional investment options, most mutual fund plans are open-ended, meaning you can withdraw your investment at any time. Mutual funds are a low-cost investment. Mutual fund houses levy investors with a charge called expense ratio. This is the amount charged by the fund houses to handle the investments made by the investors. The expense ratio ranges between 0.5% to 2.5% as per the directives of the Securities and Exchange Board of India or SEBI. Option to invest via a systematic investment plan. A systematic investment plan or SIP is the most popular way of investing in mutual funds. Through an SIP, you can stagger your investment over a period of time. The frequency of your investment can be weekly, monthly, quarterly, or biannually as per your comfort. Therefore, you don't need to have a large sum at your disposal to get started with your investment. Also, you can invest as low as ₹100 a month through an SIP. Option to switch funds. If you're not happy with the performance of a fund, or if there is a change in your requirement, then you have an option of switching your investments from one fund to another. Goal-based funds. Every mutual fund comes with a particular investment objective. Therefore, you have to analyze your requirements and choose that fund whose objectives are in line with your requirements. Diversification. As mentioned earlier, every mutual fund invests across several securities. Therefore, you automatically get the benefit of diversification and exposure towards multiple securities. Flexibility. You can initiate or terminate an SIP as per your wish, and the fund house has no say in it. Also, there are no charges levied on terminating or pausing your SIP. Since most mutual funds are open-ended, you can withdraw your investment at any time. However, you have to be aware of the applicable tax on capital gains and exit load. Seamless process. The advent of technology has made redemption and investing in mutual funds a seamless process. Both investment and redemption can be made within a few clicks. Well regulated. As mentioned earlier, all mutual fund plans are always under the purview of the Securities and Exchange Board of India, the Reserve Bank of India, and the Association of Mutual Funds in India. Therefore, your investments made in mutual funds are absolutely safe. Ease of tracking. There are multiple ways in which you can track your investments. The most convenient way is logging into your online account on the official website of the mutual fund house. If you had invested via a third party, then Even the third party offers a tracking mechanism. Now the question is, who should invest in mutual funds? Every individual who has a dream to achieve, be it short term or long term, big or small, should consider investing in mutual funds. This is because there are mutual fund plans that help you achieve any kind of goal. You have to analyze your requirements and match it with the objectives of the fund. The next question is, when should you invest in mutual funds? Unlike stocks, you don't have to wait for a particular time to get started with your mutual fund investments. This is because the fund manager and his team of analysts and experts will do the research and pick only the best performing securities which will benefit you in the long run. Also, by investing in SIP, you get the benefit of rupee cost averaging, meaning when you invest when the markets are down, you buy more units, and when the markets are up, you buy fewer units. Therefore, over time, the cost of purchase of your fund units will be averaged out and will turn out to be on the lower side. Therefore, you don't have to time the markets, and the best time to invest in mutual funds is now. Let's now understand the taxation of mutual funds. The dividends offered by mutual funds are added to your overall income and taxed as per the income tax slab you fall under. The taxation of capital gains offered by mutual funds are dependent on the type of mutual fund and the holding period. Let's now understand the taxation of capital gains of equity funds. You realize short-term capital gains on selling your equity fund units within a holding period of 1 year. These gains are taxed at a flat rate of 15% regardless of your income. You realize long-term capital gains on redeeming your equity fund units after a holding period of 1 year. Long-term capital gains of up to Rs 1 lakh a year are made tax exempt. Any long-term gains exceeding Rs 1 lakh a year are taxed at a flat rate of 10%, and there is no benefit of indexation provided. Let's now have a look at the taxation of capital gains offered by debt funds. You realize short-term capital gains on redeeming your debt fund units within a holding period of 3 years. These gains are added to your overall income and taxed as per the income tax slab you fall under. You realize long-term capital gains on redeeming your debt fund units after a holding period of 3 years. These gains are taxed at a rate of 20% after indexation. The taxation of capital gains of hybrid funds depends on the equity exposure. If the equity exposure of a hybrid fund exceeds 65%, then it is taxed like an equity fund. If not, then the rules of taxation of debt funds apply. That's all in this video. Thanks for watching.